Welcome to Think Smart with TMFG, the weekly podcast covering the financial topics that are newsworthy and relevant to everyday Canadians. Hosted by Senior Financial Advisor Mike Connon of the McClellan Financial Group of CI Asante Wealth Management Limited, here is today's episode.
Welcome to Think Smart with TMFG. I'm Mike Connon. This is John Iaconetti, Financial Advisor with CI Asante Wealth Management Limited. I think I've come to realize working with people over the years is tax always seems as something they should avoid. But paying taxes sometimes a sign that something's working.
That's often a tough idea for people to accept because when a tax bill shows up, it's like anything else. It doesn't really feel like it's a win. It feels like you owe now the CRA, and that's instantly a loss for a lot of people.
And it's because tax is obvious, it's immediate. But what gets overlooked is the gain that was created the first time. And people tend to forget the gains, and they come April, we're doing this time of year, people are reminded of the tax.
So in today's episode, we're going to unpack that idea a little bit. We'll go into, the taxation and the shock maybe that you have come April, and why that's not necessarily a bad case in probably 90% of most cases. And really, it's just a result of growth and continuing to be working forward and growing.
So speaking of unpacking that, let's go back. Why do we get negative reaction to paying tax when you've made money on something?
Yeah.
Right? So is it a good thing to have made money on something?
In the absolute basic terms, that's a great thing. Maybe you gained $100 of growth, but you pay tax and it's only $20 worth of tax. It's still a win.
So the problem is when we talk about taxes, the thing that surprises people most are what we call realized gains.
Yeah.
So when a stock goes up, let's go into it. There's different types of income, right? So if we go to the different types of income you can get is you can start off by getting interest income, right? So you get a GIC. People have mostly bought those in their life. How's that work?
So a GIC would pay you interest. The way it works in Canada is interest is 100% taxable to people. And if, like in this case of a GIC, you're paying that interest every single year. So every single year, you're going to get a tax form from the government that says you made $1,000. You add that onto your income tax every single year.
So even if you bought let's say $100,000 GIC at 5%, and it doesn't mature until it's compounded, it doesn't mature to 5 years from now. So let's say you bought it in last year, 2025. It doesn't come due to 2030.
Yep.
You don't have the money, but you still have to pay the tax on the interest every year. So if it has $5,000 each year, you're going to pay the tax along the line, even though you don't have the money.
Exactly.
It's funny, but people accept that, right?
Yeah. People have no issue with that one.
It's just how it works because we know how it works.
Yeah.
The other thing with some of these taxes too, when they come from investments, the other thing that people don't realize is when you have income from your work, right? You're getting income from your employer or you get income from a pension plan. Generally they're taking tax at source because the employer knows that what income you're going to have for the year, and there's requirements to take a certain amount and put it away to pay tax. So generally, if you work for an employer and nothing weird happens over the year, it's a pretty standard job, you're going to have no tax owed at the end of the year because it will be taken along the way.
Correct.
But does anyone know about the GIC, the investments? Not really. No. They don't know what's out there, so they're not taking tax at source. So again, this is additional taxes that could put in your income. Along with interest, you also have the dividends come in from Canadian stocks. And again, they're tax preferred, and the nice part about the dividends is generally you get them. Yeah. So if you're receiving dividends, you're paying tax on them, but you do see the money go through unless you're on what we call a dividend reinvestment program, which most people are on. So the dividends are being paid out, but they're not directly being paid to you. They're buying more shares.
Exactly. Just getting reinvested back into the portfolio. The real one I think that causes a lot of trigger for a lot of people is going to be capital gains.
Yeah.
Now, capital gains, ironically, is the best taxed option of the three.
1/2 your tax rate.
That's exactly it. 1/2 of your tax rate. So make $100,000 of a capital gain, only half of that is considered taxable at $50,000, which if you make $100,000 of interest income, all of that is going to be taxable. So it is a much more tax preferred. However, with capital gains is where people can run into the scenario of actually paying a much larger tax bill because it might be deferred capital gains for could be decades. It could be from that of a rental property or a cottage, could be that of a open account or non-registered investment account. So there's a lot of ways that you can look at it, but you made a very key point where in a lot of cases for people, it's usually the optics of tax is the bigger issue than the actual tax you pay. Because like you said, employment income, you're getting taxed at a much worse rate than what a capital gain would be. But people made money, they don't want to have to pay additionally to the CRA.
So I guess our main focus is on these capital gains.
Yeah.
Let's talk about a realized and unrealized capital gains.
Capital gains is different from interest and dividends, like you mentioned, because you won't be forced into realizing any sort of capital gains. So imagine you bought a cottage, it's worth $100,000, and in 10 years' time, it's worth $200,000. You don't actually realize any sort of capital gains until that property ends up being sold.
So every year you're not going to tax bill for how much your property increased.
Exactly.
It just goes up and it's being deferred.
Yeah.
Until you make the decision to realize. So that's the other thing about realized capital gains is actually, generally speaking, you're making that decision to realize that gain. And I guess that's why people get upset with it, because it is actually a bit under their control once we get down to that. So the real question is, well, why are we going to pay tax? If it's under our control and we don't necessarily have to, what are some of the reasons why we would actually realize that gain and pay the tax on it?
Yeah, well, there's no getting away from it. I think that's the most important thing that people need to understand. It's either you're going to pay tax for it in your lifetime or upon your estate.
Yeah.
The reality is the tax is going to get paid one way or another. And in most cases for people, it may actually be more beneficial to realize it while you're living. It'll be at a much lower tax rate, especially if it's a joint account between spouses and you're able to share the tax rates. There's a lot of benefits that you can do while you're living. If you pass away and leaving behind a large estate, it's very likely that you could be paying 53% or the top marginal bracket in your estate.
I like to remind you, everyone's last words are sell everything.
Yeah.
And that's what people don't realize. And if you have, let's say, $200,000 or $250,000 in, let's say, a RIF, that's automatically put on your income.
Yep.
And once you get over that 225 to 250,000, every penny you have after that is under the 54% tax rate. You may be complaining about paying tax at a 30 or 40% rate, but it's still nowhere near that final tax rate that people have to deal with. So sometimes it doesn't make sense to strategically realize some gains throughout your lifetime when you're in lower tax brackets.
It's coming up with a strategy to minimize the amount of taxes that you'd have to owe. A lot of people just wish that we can just, wipe our hands of it and never have to pay tax going forward. You're going to have to pay it, but why not come up with a strategy that's going to be the most beneficial to you and your overall situation? And for a lot of people, that might mean biting the bullet while you're living and actually physically have to pay it. Some people just hope they pass away and just let their kids have to worry about it.
Yeah, it's not me that's going to be paying it. So let's go into the other reason why we would realize gains on purpose and decide, okay, we're going to pay these taxes on purpose. Now, what we're doing a lot of times is rebalancing portfolios. Whenever we come into a rebalance decision, it's very easy when people have large, let's say, RIF or RSP accounts, because a lot of times you can do some of the rebalances inside of these accounts.
Yeah.
If people don't have, or people have significant assets outside of that, many times they're forced to do those rebalances in open accounts that are taxable from those gains. So that's a big thing to take on. The problem is whenever we talk to people, we do discuss what that rebalance is going to cost, but sometimes we'll be doing that in January in a year, and you're not going to have the tax bill until April of the following year. It's almost 16 months later by the time you get your tax bill. So again, a lot of that gets forgotten are the reasons why I did this and why I'm paying the tax bill now. When we talk about doing rebalancing, there was this term always called, you should never let the tail wag the dog. And the idea behind that is you should never let the smaller financial importance rule the larger financial importance.
Yeah.
So when we're rebalancing a portfolio, we're trying to take gains and lock them in. And unfortunately, when you do that, you may have some taxes triggered. But once you lock in those gains, you've made a decision that's positive in a financial manner. So don't get so caught up in the situation of the taxes that are due to let you be in the wrong portfolio. You're a bit younger than me, so you won't have gone through the experience that we went through with Nortel. Nortel was a company that most people know became the biggest company in Canada during the end of the 90s. And in the year, it was a kickoff of Bell stock. And many old ladies at the time all had Bell stock. And they would have ended up with $1 million worth of Nortel stock. And it didn't fit their profile at all. You have a high-tech company with someone who's in their 80s, who is 95% of their portfolio. It just made zero sense. And at the time, we would meet with people and we'd say, okay, this doesn't make any sense. This has been you had the goose that laid the golden egg. You're a millionaire. You never dreamed of having that. This is the greatest thing ever. Your life is set now. So let's sell the Nortel. And they say, well, I don't want to pay the tax on it. There's $1 million. My tax bill is going to be $250,000. And we kept on pushing and said, we'll just pay the tax. So it's okay. Well, I don't want to pay the tax. So if you don't sell and take care of it, the market will take care of it for you.
Yeah.
And by 2009, Nortel was bankrupt. They no longer had a tax issue and they no longer had $1 million.
Yeah.
It solved itself. And that was a big lesson that's ingrained into us now, because we know when we have these high performing parts of the marketplace, at a certain point, you have to go and lock those in and take advantage of it. And you have to eat a bit of the tax cost to do it, but you're protecting that asset.
I mean, obviously an extreme example, a lot of people, might be listening and thinking, well, that was a one case scenario. That's not the case. Companies like that, very successful companies, all goes through a business cycle. There's a rapid expansion and growth and prosperity, but there's also going to be the other end of the coin, because that's capitalism at the end of the day. It's a competition style basis in terms of trying to compete for every dollar within the marketplace. So while there's a gain and while the company's doing incredibly well, to your point, Mike, avoid the concentration risk, realize the capital gain.
Every time we go back to 2006, 2007, financial companies were blowing the roofs off, Bank of America, all these companies. And what happened was people got greedy, didn't want to sell because of the capital gains. And again, you find some of those stocks, the big banks in the States went from $100 a share down to $4 a share.
Yeah.
And if people would have got the gains off and not worried about the tax, they'd have the money to hold on to. And so you got to make sure that tax decision does not wag the dog of the financial decision. And that's key. We just have to make sure when you're going through, we always do try to make people very aware of the tax consequences. But you have to remember that throughout the year, because a year later, you're going to have to pay that tax bill. For that year that you have the money, it's in your hands rather than government's hands, which was very good last year because the markets were very strong. And it was nice that you didn't have to give it out to the government right away. But at the end of the year, when April comes along, you have to pay those bills. We can conclude that paying taxes is not necessarily a bad thing. In many cases, it's just a result of something working, whether that's growth, income, or investments, or decisions in the right way as they should.
And that's exactly why it's less about avoiding tax and should be more focused on maybe a loss aversion type of lens, and more about understanding when and why you're paying it. To those listening, if you're wondering how this applies to you, whether it makes sense to realize gains now, defer them, or structure things differently, those are exactly the kinds of conversations we have with our clients every day. So if you want to learn more about TMFG, check out the show notes for details on how to connect with us. You can reach us at 905-771-5200 or visit our website at tmfg.ca. Also, if you've got questions, feel free to leave a comment and we can cover them in a future episode.
Thank you very much for listening. That brings us to another end of another episode of Think Smart with TMFG. Have a great day.
You've been listening to Think Smart with TMFG with Mike Connon of the McClellan Financial Group of CI Asante Wealth Management. Don't forget to subscribe to Podbean, Apple Podcasts, Spotify, or YouTube Music, and leave us a review. For more insights and resources, visit tmfg.ca or follow the link in the episode description. This program was prepared by Michael Connon, Senior Financial Advisor with CI Asante Wealth Management Limited. This is not an official program of CI Asante Wealth Management Limited, and the statements and opinions expressed during this podcast are not necessarily those of CI Asante Wealth Management Limited. CI Asante Wealth Management Limited is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. This show is intended for general information only and may not apply to all listeners or investors. Please obtain professional financial advice by contacting us at 905-771-5200 or visit tmfg.ca to discuss your personal circumstances before acting on any information presented.